So today I want to talk about why a strong dollar matters and really just jump right into it. The strength of an economy is reflected in the strength of its currency, and the U.S. dollar has actually been the strongest currency, one of the strongest currencies in the world. And before I get into this, I'm not a dollar expert, but we do study its impact on our investments and on the investment thesis. But it's interesting. Martin Wolf says, the dollar is the world's refuge and strength, even when the U.S. is the cause of the problems, as we were in the great financial crisis and probably were in this round as well, mainly because we were so aggressive on the easy money policies that we had and put over 55% of U.S. GDP to work. That's where part of the problem came from. So today I want to talk about why has the dollar rallied, what are the implications, and where we think it should be looking to invest today. So as you can see from this chart, against the G20 currencies, only Russia, Brazil, and Mexico have had positive returns since the beginning of the year against the dollar. You can see all the other major currencies going the other way. There's been a lot of discussions about the UK, and they're keeping some pretty odd company with Turkey and Argentina, not exactly bastions of economic strategy and strength. So you can get a sense of how troubled Europe is, and the UK is just from how weak their currency's been and how desperate some of the attempts they've made to get the economy on the right track have been, and the big reversal that they've made. One of the reasons the dollar's rallied is how aggressive central banks have been in tightening, including the US. But I mentioned Brazil has had a strong currency, as have Mexico, and those guys have been as aggressive, if not more, than the US has been. Brazil starting a lot earlier, but you get a sense of how much intervention has gone on in the markets as well from central bank policy. But I think the real reason the dollar's rallied is there have been four major shocks hitting the global economy all at once. And when those shocks hit, people flow to safe havens, which is the dollar. So it started with the pandemic. Then in response to the pandemic, we put 35% of global GDP in monetary and fiscal stimulus. And in the US and other developed nations, over 50% of GDP to counter the pandemic. That led to the pandemic, and other issues led to supply constraints, meaning very unusual demand dynamics, which weren't the normal flow pre-pandemic, which created further strains, which were starting to work themselves through until we had Russia's invasion of the Ukraine. And just to give you a sense, when people talk about the Fed and being wrong on transitory and all that, if you look at the number of ships docked outside the port of LA and the port of Long Beach, in January or December, it was about 106. Now that number's down to 6 ships docked outside. So you could argue that without the Russian invasion, there would have been a significant decline in inflation, notwithstanding the labor market forces. But in other areas, we see where there was a lot of inflation coming down. But the war did happen and food and energy prices rose. That led the Federal Reserve to really react by tightening ahead of their peers in some cases. And that's what put us into a position where the dollar is rallying so aggressively. It's rallied in large part relative to other economies because of the cost of energy and what that's going to do. And this chart I showed last week, but it's another chart that shows you how much energy prices have changed pre-COVID and now versus what the impact of the Russian war has been. And you can see the 2 or 3 times increases in as a percent of GDP of energy costs. That's a real issue that's going to be with a lot of these nations for some time. You can also see on this chart, on the left-hand side, you have the US, the Euro area, and the UK. And if you look really what's been going on since the beginning of this year, how much more aggressive the US has been versus Europe and the UK. And that's part of the reason why you see their respective currencies down. In the Euro, it's down about 13%, and the UK, it's down about 20% year to date against the dollar. I also mentioned Brazil and Mexico were aggressive and have positive currencies relative to the dollar this year. Part of that, as you can see in the blue and the red on the right-hand side, is how aggressive those two guys have been, nations have been relative to India and South Africa, for example. So what are the implications of a strong dollar? Well, it is highly contractionary on the global economy. It puts a lot of pressure on the global system. And it really goes back to the US dollar has an outsized role in the capital markets relative to our GDP. We have the most liquid, most mature capital market system, and the dollar is very heavily transacted around the world, as I'll show you in a minute. Most currencies trade in dollars, and when you have currency spikes like we had this year, and commodity spikes like we've had this year, you start to see more strains going on the people importing, and that's really been a detriment. But I think a really important concept that people keep in mind and how the strong dollar actually helps the US. We are importing deflation. And what by that I mean, we have imports annually projected for this year to be about $4.06 trillion. If the dollar is inflated by or strengthened by 10%, we're getting a benefit in the US of about $400 billion of lower costs because of the strength of the dollar. On our export side, we only export about 3 trillion, just shy of $3 trillion. So while we are exporting some inflation to other people, we're actually getting the bigger benefit by importing deflation into the US. But it's also a real problem for countries with high liabilities, particularly in the emerging markets, and particularly those with high dollar-denominated debts. As the dollar strengthens, the cost of their debt gets more expensive and their debt servicing costs go up. That creates bigger problems for them as well. And you're starting to see a lot of changes in capital flows that once the US does something, or the UK does something, or Europe does something in terms of adjusting policy, other economies react to it because we're an interdependent global economy. I think the other reason the dollar is strengthening is you have Europe facing high inflation from energy costs and weakening demand, slowing growth, and the likelihood of them tipping into a recession. You have China dealing with their slowdown from the lockdowns. You have the real estate bubble that continues. They have their demographic issues. And then lastly, in the emerging economies, you have high inflation, food prices, higher borrowing costs, and growing social unrest. So in times like this, people seek safe havens, and that is the dollar. And just to give you a sense of how important the dollar is globally, you can look at it from FX transactions, currency reserves, cross-border loans, SWIFT payments, and the like. And you just get a sense of how outsized it is relative to our share of world GDP and our share of global trade. So you can get a sense of how important the dollar is through this chart. I think the other issue that's facing us is the reason for all the tightening of conditions is the high inflation that we have, and central banks are trying to bring that under control. And you can see from this chart what the OECD forecast for inflation was back in December in the dark blue and light blue in September. And in each case, it's significantly higher inflation expectations. That's putting greater strains on governments to respond. And their response is creating some of the challenges that as one country responds, another country has to respond to that. And that actually creates this spiraling. And what we could see is either a reverse currency war where people are trying to strengthen their currencies to offset their inflationary pressures, or they're going to, which is the opposite, when they usually try and lower their currency so that they can export more. Right now, it's an inflation battle. It's not a GDP battle for them yet. And I think that's part of the problem. So where to invest today against the backdrop where Putin's certainly escalating things. Yes, Mark?
Could you stay close? Because we're hearing some kind of background noise, but when you're closer, for some reason, you don't have it.
Okay. So where to invest today? The same themes we've talked about: electrification and clean energy. I'll give you some examples of how we're playing that. Digitalization. We're only in the US about 11% of the economy is attributable to the digital economy. We think that's going to continue to ramp up as companies are faced with higher input costs, higher labor costs. They're going to focus on productivity enhancements and ways to lower their costs. That is going to require digitalization. National security is a bigger and bigger issue. Putin escalated things considerably with the annexation of the regions in the Ukraine that he was going after, and then the sabotage of the Nord Stream pipeline really creates a whole different view of national security right now. So I think that's another area that you can continue to play and benefit from. Biotech and others lowering healthcare costs is going to be a theme for the next decade and beyond. And I think companies with strong growing dividends, which means they have good balance sheets and healthy cash flows and free cash flows, are going to be really important in this environment and special situations. I would point out that in the public markets, in the US S&P has seen their multiples go from about 22 down to 15 this year. That's a pretty significant adjustment. That puts it in line with its historical average. So you could argue that the market's probably a little expensive right now, notwithstanding the likelihood of a near-term rally. But we're going to have to work through the process that we're going through right now. And you really want to focus on companies that have really strong cash flows and strong balance sheets. And our special situations companies are ones that fit that category because they can buy back. They've announced buyback plans of 15 to 30% of their stock a year for the next several years. And that gives you a sense of how big a divide there is between the have and have nots. I just want to show how we're playing this from electrification, clean energy, and our flagship strategy. From the old energy, which we think is going to be essential and with us for at least 20 more years, maybe even longer, to affect the energy transition. We like the Pioneer and EOG companies like that, where they are not investing for growth, they're investing for profitability and for returns because they're not getting the lending that they used to get. In the solar area and industrial solar area, we like a company like Array Technologies, which actually helps solar panels align with the sun so that they optimize the solar rays coming in and get the maximum out of it. So there are companies that you can play that are more technology-driven companies that are going to play this. We like that. Flextronics is another one. Flextronics is also somebody with a massive buyback program for the next several years. And then as we look to move through the clean energy transition, you're going to need companies like MP Materials, which does the rare earths for the magnets for the EV cars and batteries. They're also a Freeport-McMoRan, where copper is going to be in a massive shortage against the global demand. So that's another way to play that. And then on the national security side, you've heard from Ukraine the demand for more drones and more support because of what drones allow them to do to protect themselves in a very difficult environment from the attacks that they're having. Drones is a big part of that, and Kratos is one of the big players in that area. Raytheon Technologies does a lot of the Patriot missile systems and the like, so essential for that element of it. And then L3Harris, which was L3 Technologies merged with Harris Technologies, and that became this company. They're big in munitions, and there's a whole refresh of the munition systems that we're going to have to go through as we modernize and deal with a new setup for war. In each of these cases, these companies have strong balance sheets. They have their labor costs are somewhat better managed because they get support from the government for their pension plans and the like. And it's interesting, if you look at the weighting of the S&P to aerospace and defense, not just defense, but aerospace and defense, it's about 2.6% of the S&P weighting. Defense companies would be about 1.8% of that, 1.7. And if you think about that, you can buy the top 5 defense companies for less than $1 trillion. So there is not a lot of as market cap here, but high demand, and you can actually get some really nice outperformance, particularly in a less stable world like we're in today. I want to leave you with one last thought because it gets to how interconnected the global economy is. And on Friday, Lyle Brainerd, who's the vice chair, made this statement that the Fed has to watch how their tightening and their initiatives to combat inflation create problems elsewhere. And the reason I bring this up right now is typically you don't see coordinated currency actions. But I think we're moving to a period where if things get too sloppy, you may see coordinated action, which would be a very big positive for the equity markets in our view. We think that it would clear some of the concerns away of what's going on and create a situation where you could put the economy back into a position where equities have a pretty significant move and you start to stabilize some of the distortions that are going on in the global economy. So I'm going to stop there and open it up more for discussion.
Well, thank you. Usually you're so lately you've been rather bearish, but you show some bright spots. Let's open this up.
Stephen, how long do you see this? Do you see any weakening? Is the strong dollar sustainable for how long? And what would weaken the dollar?
Well, other central banks getting more aggressive would obviously weaken it. If they really get aggressive and can bring their inflation under control. I think that's one of the areas. I think we're going to have a little bit of a, if not a stabilization, a likely reversal because it's moved so far so fast. It would be natural to see some ebbs and flows away from it. I think getting China back on a more sustainable growth and getting them past some of their problems would also have an impact. But I think a lot of this in the near term is we're just going to, you need the more mature economies, the other advanced economies to be on stronger footing, and they're not. You saw that with the UK. Their economic plan has been skewered, sent to the drawing board and back again. And, so I think until you get a more sustainable growth rate from the other parts of the world with lower inflation and better actions to bring inflation in line, I think the dollar will remain relatively strong to the competitors anyway.
Yeah, the reminder, stay closer. Somehow there's still this background noise. Sorry. Other questions? Don't be shy. Wait, hold on. Actually, Michael Hammer, you had your hand up.
Michael?
Sure. So I've been in and out of Kratos over the years. More recently, they've drifted down from the 20s to just above 10. So that is interesting. But they never seem to have broken out. Harris, I'm familiar with professionally, not as an investor, and they certainly do have a lot of strengths. But what's interesting to me is you have Raytheon. Lockheed Martin wasn't on your list, and yet they're the producer of HIMARS, Javelins. So they clearly are going to have product that's in demand. Any comments?
Yeah, they do have product that's in demand, and we've owned them all at different points in time. Raytheon, we also believe that the commercial industry is going to start coming back. So you'll get a lift from that side of their business as well. Lockheed still has frustrated the world for however long they've been doing the F-35. The argument against Lockheed has always been they've spent a lot of money on a plane that is viewed as having limited value. I think that's always been kind of the hamstring, while they have a lot of other good things. The other thing I'd point out with the biggest defense companies is they are among the best sources of cyber technologies being developed, except it's such a small part of their overall revenues that you don't get the lift from that you would. You don't get the multiple that you would as Palo Alto or some of the other cyber companies would.
Stephen, is that cybersecurity that those defense companies are coming up with? Is that driven by their own security, or and then they roll it out commercially?
No, it's mainly driven by the Department of Defense needs.
Okay.
Paul, you had a question? Or Zarin, and then Zarin? Good to see you, Zarin from Zurich.
Yes.
Hey, Stephen, there's been, you haven't talked much about the impact of Hurricane Ian on the dollar, as well as what the trickle down is going to be on the car market here in the United States. Do you have any thoughts on either of those topics?
Well, Ian, aside from being just another human disaster that we're facing, I think the impact on the dollar, I don't think will be that great. I think it will represent a small part of our GDP, the damage and the repairs for it. And insurance will pay for some portion of it, but it is actually going to lead to more of the rebuild that we have going on and more infrastructure in the US, which will be good for a lot of the steel and commodity producers again. So I think that I don't think it'll have a major impact on the dollar. I think it'll give some new investment opportunities or some more infrastructure plays, but definitely something we have not prepared for and not made the adjustments we need to make to get our nation more secure from natural disasters either.
So, Zarin, it was great to meet you. And as I said, you made there's an art to an email introduction, and Zarin is up on the top, toward the top of the scale. When she said she's going to make some introductions, I feel like I took a lot of your time over the last since we met with your introduction. So thank you for those.
No, well, thank you. You made me shy now. I appreciate your commenting. And Stephen, great to, hear you and get the insight. Actually, just yesterday, I was with a Swiss manager and we were on the subject. You answered one of the questions I was going to ask about the commodities. They are overweight on commodities, also utilities and materials. And they have a conviction that the US bond market will go up, but they have taken a beating from that, but they're still determined. So they're holding on to the position. So I was wondering, I know that you're more equity based, but if you have a view on that.
Yeah, I think if they believe we're getting closer to the peak of interest rates, they're probably right. We're not there yet, but we're getting closer to it. But it's been a painful process. If you're along the 10-year, you lost a lot of money this year. Just it's a real beating. But I guess you've lost probably almost 25%, 24%. So I think we're getting closer to the top of the rate hikes in the U.S. But I don't know that you're going to see the big rate drop. So the best answer would be if you're getting around a 4% yield, at least it is a reasonable alternative if you can hold to maturity and you want to balance out your portfolio and have some more liquidity. I think that's not a bad idea. I don't see a lot of downside from rate moves other than you may have another 1% move, which on the 10-year would mean another 8% loss in principal if rates move up 1% from here. But I think you'll probably have maybe 50 basis points more, 75 basis points more before we top out.
Thank you.
A lot of it depends on whether, I was negative last week, so I'll get back to the negative part. A lot of it depends on how the US does, because I think it's pretty locked in that Europe and China are going to have a recession. The question is, does the US have a recession or a slowdown? And if we have a slowdown, that's materially better for us and we'll strengthen the dollar more. But I suspect it's 50-50 right now, whether we have a slowdown or a recession. So it's not easy betting on this one. It's still for us a time of caution, but the areas that we talked about that I just showed, the pullback in those has been significant. And you look at some of the best tech companies, the chip companies and the like, and they're selling for 50-60% less than they were at the start of the year, with very single-digit multiples and strong earnings capabilities. So we're very excited about the opportunities 2 years out, 12 months out, but the next couple months are going to be tough.
Stephen, I see Jack Wyant with his finger up.
Stephen, here's a question that relates to what seems to be the deeper and deeper dive that you and your colleagues have taken into alternative energy. And you have Canadian roots as a corporation. Brookfield is a Canadian-based company that that has emerged as a major player in alternative energy. Do you all have a view on Brookfield as an equity security?
We don't own it. We couldn't have more respect for a company than the way Brookfield has built their business. Our Canadian relatives speak highly of them. They were with them the other day, and I think they're cautious on the markets as well. But I think Brookfield is one of the handful of finest financial services companies out there. I don't know if that helps you, Jack, or not.
Hey, Stephen.
One second, Jack, how did things go with your annual meeting yesterday?
Well, in a word, splendidly.
Good. Well,
If you wanted a few more words, it was all good. Productive, helpful, and Stephen's brother, who goes by Sean, was here in Cincinnati in person, and
right.
and he would be a good acid test because he's a no BS sort of guy, and I think he loved it. He liked it so much that he went to a Reds game and stayed till past the last inning.
Okay. All right. Good answer. We'll connect. Sorry, who else had a question?
Yeah.
Bill,
Bill?
Sure.
Bill Dick? Yeah, go ahead, Bill.
Yep. So Stephen, what do you think sort of the confluence of the Brainerd quote that you had on there, which I thought was interesting, along with, it looks like maybe we've just sort of rolled over a little bit on job openings. And of course, the last ISM number was sort of a, continuing data point in the slide. Do you think that perhaps the Fed might be telegraphing something, or is that too much wishful thinking?
I think they're telegraphing a coordinated action more than a pivot. I don't think the Fed's going to pivot easily, because Brainerd also said that they have to see inflation. They have to bring inflation to its knees. So I think the Fed's people hoping for a Fed pivot soon. Mohammed Al-Arian was out yesterday saying if the Fed pivots, it's because something really bad had happened. So I don't think hoping for a Fed pivot right now will be the Fed pivot of the past without a lot of pain. I think they'll pivot when there's a lot of pain, and that'll be a challenge. So I think they're sending a message that they're going to fight it all the way through, but they may need some unusual action that could be coordinated, so you don't have a race where people are trying to strengthen their currencies, which usually doesn't work very well.
Stephen, Andrew Rendeck here. Great to see you. Thank you for your
Andrew.
insight. I think you're absolutely right about the pivot. The Fed's not going to pivot until they're going to be like all Missourians. They're going to be show me state kind of people. But the market's going to pivot before the Fed does. And the market's probably going to beat the Fed to pivot 3 to 4 months. Fed's going to overstay its welcome.
Do you think that's a bad thing? If the Fed
Well, back to our friend from Zurich. I don't remember her name. I'm sorry, I hadn't met her
Darren.
before.
Darren.
The corporate bond market's been basically shut for the last 6 months. Net new supply is down. Rates, 2-3 year single A, triple B, or you're in the 450 to 550 range. Free cash flow coverage is massive. I mean, 11 times for 12 times for investment grade, A rated, and you're talking 5-6 times for, double B, triple B. I mean, you've got basically the best credit conditions you could imagine. If we're going to go into a recession, this is where you want to go from. That's for sure.
Yeah, I got a pitch the other day for senior subordinated debt too. As another place people might want to be going to right now. Open to that idea, but we're not rushing there.
John Dennison?
Yeah, thanks, Mark. Stephen, my friend, great to see you. Great job as always. Kind of a bigger picture softball for you, hit it wherever you want, if you want, is we've been in this very unique monetary environment for a very long time now, since the Great Recession. And I wonder, and it's just intersected with other global events, but I mean, the dominance of monetary policy in the economy in America and globally is, I think, unique in history right now and for the past 15 years. Do you have any comments just from a policy perspective, monetary policy? What are the lessons to be learned from the past 15, 20 years? Go back longer if you want, just on how the US executed its monetary policy.
Stephen, before you do that, because John is a Michigan alum, he already has 5 answers. Can I ask you, John, what is,
And all of them wrong, because I went to Michigan.
but what can I throw it back to you for a second? What do you see?
Oh, I was asking the smartest person in the room, Mark.
All right, I'll pause on that, but I want to.
Yeah, Stephen is a great thinker. All
right, I'll let Stephen go.
Yeah, he's a great thinker. I'm a rank amateur.
I think the early part of QE after the great financial crisis was the right call. I think we stayed with it way too long. And I think I think the problem with zero interest rates at an extended period is it creates all the wrong behaviors. And we lost what true valuation really means in the markets, and both private and public. And I think what we're entering into a phase, and this is something we're writing our next outlook right now, is that we all have to go back to an adjustment where normal interest rates, normal central bank policies, normal market valuations all apply, and that you don't have the artificial stimulus that goes on. I think that's one element of it, that for all the Fed criticism, they did the right thing at the right time. And you knew it was right early on because we didn't get inflation that everyone thought you were going to get inflation, which meant there was so much slack that the deflationary pressures were really there and high. I think that we've transitioned where 3 of the 4 drivers of deflation are now questionable, where they were full tailwinds. Now they're headwinds. So I think that's a big change. And the only one that's not really is technology, which continues to be the big deflationary answer. So I think the other issue that I would just say is, I think what we found in the last 9 months is that modern monetary theory is still a theory, and in practice, it probably doesn't work.
Can I
say that one word? Does or does not work?
Does not work.
Can you give me a paragraph more on that?
Well, I mean, the idea that you can keep spending money and increase your deficits, that you can do deficit financing in unlimited ways.
Sorry.
Which the Bank of England was about to try and got a loud rejection of that now.
Yeah, I'm with you.
I think that in theory it works, but Yogi Berra had a great line, and in theory there's no difference between theory and practice, but in practice there is. And I think what we're starting to find out on monetary theory is that it really is a theory and not a practice that works. So I think we just did too much on top of it and didn't, because the short-termism, didn't let things work and didn't take the normal level of pain that you need to take at certain points in time. So I think we have to go back to more normal pain policies, which are hard, but I think that's just the way it works.
See,
All right,
Mark,
I want to
told
ask
you. Mark, I told you.
Yeah. Well, it's good, but it's important to have good questions, right? So good job, John. So there are other people I wanted to call on, but some people popped on. I know Andrew, yesterday you emailed me. You wanted to chime in here. You want to do that?
Yeah, Mark, can you hear me?
Yep.
Yeah, my raise hand button just disappeared. I don't know where it is.
That's
was
right.
there. It's not there.
Okay.
First of all, just to follow on what I think it was John that said something, and is just going back to not Fed policy, but think of Fed policy as global. You take the Fed, you take the ECB, add on Great Britain, add on the BOJ, and then throw in Chinese central bank policy as well. So what happened was approximately 10 years ago, as rates were coming down and bank balance sheets were going up, whether intentional or not, we can not even worthy of discussion, it was synchronized. So all the people running around going, wow, inflation's going to go through the roof. We got to buy gold. And of course, that didn't happen. But it didn't happen because currencies and rates in a globalized world are relative. They're not absolute. So one of the things I think that we tend to do here is focus so much on the Fed without just looking at what other central banks are doing. And I think the obvious upshot of that is what's happened in currencies in the last, this year. And what you're seeing is interest rate differentials driving humongous, I emailed Mark, once in 100-year currency moves. With that said, it also ties into inflation. So one of the things I've studied over the years is cycles in energy prices and how they sort of roll over into the economy. And there's a lag, and it's not absolute, but approximately, if you look at valleys and peaks, you have about an 18-month lag as to the inflationary impact of that. And what tends to happen is when you get in, we'll just call it an oil shock, because not always oil, an oil shock, you set off a inflationary mini spiral, meaning you get a shock, then you get a period where there's adjustment, but then there's essentially a second wave where impacts are secondary. They come from logistics, they come from employment, they come from other things. And these begin to fade over 18 months. And so we peaked, I believe, maybe Stephen remembers better, I think at the end of June, or right near the end of June was the peak of energy. And so what we can begin to see here, and I'm emphasizing the word here, is a sort of leveling out of that. And now what we're tending to see is inflationary factors being driven by employment, by asset levels, obviously not the stock market, but real estate, things of that nature. What I emailed Mark is that for a minute, take the view of those asset prices and inflation. If you are sitting, I was emailing some people I know that invest in Japan. I use Japan as an example. I used to do a lot of Japan investing years back. And so when I was talking to a person a few weeks ago who was whining about how she had owned a lot of gold as an inflationary hedge, and it wasn't working. And that gold actually had gone down a bit, not even close to what bonds or equities had gone down, but it certainly didn't go up. And I said, well, if you were sitting in Japan, you owned yen and you owned gold, you had an absolutely fantastic hedge. It was a wonderful hedge. And you could take the same view, obviously, if you're sitting in the UK or in the euro. And so I think we have to look at a lot of these factors as a globalized world. And in doing so, also look at what central banks are doing in reaction to global inflationary pressures. But as usual, the ECB is lagging. The central bank in the UK, that's a whole meeting discussion.
Andrew, I just want to keep it flowing.
Sorry, Mark. So that's the gist of it.
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.